Hi. Let's learn about the capitalization rate. The capitalization rate, also known as cap rate, is used in commercial real estate to show the anticipated rate of return on an investment property. It is calculated by dividing the net operating income by the property's value and is expressed as a percentage. The cap rate indicates a property's intrinsic, natural, and unlevered rate of return over a one-year time horizon, assuming the property is purchased on cash and not on loan. The capitalization rate is calculated by dividing the property's net operating income by the current market value. Net operating income is the expected annual income generated by the property minus all the expenses incurred for managing the property. The current market value is the present-day value of the property as per the prevailing market rates. The cap rate value will be higher for properties that generate higher net operating income and have a lower valuation, and vice versa. A lower value cap rate corresponds to better valuation and a better prospect of returns with a lower level of risk, while a higher value of cap rate implies higher risk and lower prospects of return. The capitalization rate can be calculated using the Gordon growth model, which is a method for calculating the intrinsic value of a company's stock price independent of the current market conditions. It can be used to assess the valuation of a property for a given rate of return expected by the investor. The capitalization rate is less reliable if a property has irregular or inconsistent cash flows. It does not take into account future risks or changes in the rental market that could cause income fluctuations. Generally, a good cap rate falls around 5% to 10%, while a 4% cap rate indicates lower risk but a longer timeline to recoup an investment. However, there is no single value for what makes an ideal capitalization rate, and investors should consider their own risk appetites when evaluating a property. Market factors, location, competing properties, future trends, and the amount of capital invested can all affect the capitalization rate of a property. The capitalization rate can vary based on different scenarios with variations in rental income, expenses, and the current market valuation of the property. The capitalization rate for an investment property should be between 4% and 10%. The exact number will depend on the location of the property as well as the rate of return required to make the investment worthwhile. Determining whether a higher or lower cap rate is better will depend on the investor and their risk profile. A higher cap rate indicates a higher risk, while a lower cap rate indicates lower risk. Return on investment indicates what the potential return of an investment could be over a specific time horizon, while the capitalization rate tells you what the return of an investment is currently or what it should actually be. Here are 3 key takeaways. 1. The capitalization rate is calculated by dividing a property's net operating income by the current market value. 2. This ratio, expressed as a percentage, is an estimation of an investor's potential return on a real estate investment. 3. The cap rate is most useful as a comparison of the relative value of similar real estate investments. Hope this would help. Thanks for watching.